Have you ever wondered how the government's going to get us out of this debt crisis? And where should we be invested as a consequence? How will the U.S. election affect your portfolio going forward? Hi, my name is Kareem Zakir, and I want to welcome you to my web capsule. If you like this video, I would appreciate it if you can click on the like button and or send it to your friends and family. It gives me visibility and enables me to grow my practice. And if you're not amongst my clientele and would like to have access to these videos, simply go to YouTube, write my name in the search bar, click on the subscribe button underneath my video screen, and then click on the bell and you'll be notified as soon as it goes public. Okay, so first off, I want to say thank you to everyone who responded to the survey I sent. And it just confirmed to me that doing these capsules is definitely pertinent and informative, and I will continue to do them. The vast majority requested it on a quarterly basis, so I will do it on a quarterly basis, in addition to my write-ups for the portfolios that I manage. Okay, so how will the governments get us out of this debt crisis? Well, there's really three ways this can be achieved. One is to grow our economy as fast as possible, and being in a recession with a lot of unemployment, that's not going to happen, not now anyway. The second option, which is very unlikely, would be for governments to default on their debt or restructure their debt. Very unlikely. And third would be to inflate our way out. And with the massive liquidity injections that the governments and central banks are pursuing, this outcome seems to be the most likely scenario, because they're printing a lot of money. With printing a lot of money, the value of the money tends to drop. The price of goods tends to rise as a consequence. That's inflationary, and it actually could turn into being stagflation. Stagflation means that you have inflation with no economic growth. So this is going to possibly be an issue down the road. You'll notice that, for instance, the price of copper is up year to date 7%. The price of lumber is up over 50% year to date. This means that to come and build a home, infrastructure costs, all those are going up. It's quite inflationary. In addition, food prices are going up as well. On the services side, prices are not going up all that much because wages are not rising as fast as the price of goods. But in essence, we are starting to experience a little bit of inflation, and it could become an issue down the road, and we should look at investing accordingly. First thing I want to talk about a little bit though is the S&P 500. The month of September was a little bit wobbly. The S&P dropped a little over 7%, and this is actually quite healthy and quite normal. When you look at the chart, you'll see that since March we've had several drops in the area of anywhere between 5 to 10%. And this is actually, like I said, quite healthy because it resets the markets. It removes the froth from the market. It hurts the speculators who are trying to speculate and trade their way through the market. And it's also a reminder that it's not that easy to make money in the market. You don't know when the drops come, and they can come very rapidly. And we don't know if they're going to be significant or they're just going to be shallow, and then you'll get a rebound in the market. And incidentally, more people have actually lost money waiting for a correction, sitting on cash, than actually going through a correction. And so in my 30-year plus career, I have yet to see anybody make money in the market trading their way in and out of the markets. By trading your way, what you have to do is get two decisions correctly. One is to know when to get out, and two is to know when to get back in. So this brings me to my next subject. Where should we be invested? Well, when it comes to stocks, you need to look at investing in the right sectors, which is what I'm aiming for. So the work from home type businesses are going to benefit from this new economic paradigm that we're going through. Another sector that's doing extremely well is the healthcare sector, for obvious reasons. And ground transportation is booming. With all the e-commerce that's going on, ground transportation can't keep up. Even in my own household, we're getting packages sent to us on a daily basis, something we've never had pre-COVID. So this is a sector that's actually becoming very significant. You know, the CNs, the CPs, the FedEx, the UPSs, all those companies are going to benefit from what's going on right now. In addition, in other sectors that we should look at are, for instance, inflation-linked bonds. If inflation becomes an issue down the road, whether it be stagflation or inflation, you want to have a percentage of your portfolio in inflation-linked bonds. And also, you want to have precious metals because they tend to benefit from an inflationary economy. So precious metals, and in particular gold, plays a very important factor in the portfolios. As I have always alluded to, the only free lunch we get in this industry, in this business, is diversification. And it's so important to be not only properly diversified by different sectors, but also manage the risk within the portfolios. Managing risk by knowing what percentages to allocate in each stock, each category of stocks, and for instance, each asset class. Diversification, in essence, is accepting the good, missing out on the extraordinary, but preventing the tragic. And this brings me to the US election and how it will affect your portfolio going forward. Will there be a recount? Will there be fraud? Will they declare a president the night of? Are they going to wait 3 months to declare who the president of the United States is? It's nerve-wracking to many people. They don't know what to do with their portfolios, with their money, and how the money should be allocated. Should I go all to cash? Should I stay invested? Should I go all into gold? The answer is absolutely not. Okay? The way to manage the portfolio is, again, to be diversified. And I want to put up this graph to show you how the stock market has performed before, during, and after a presidential mandate, going back all the way to 1926. Based on this graph, you'll notice that there are only 2 presidents going back 100 years that have actually not made markets rise during their mandate. The first being President Coolidge back in 1929, for obvious reasons. We had the Great Depression. And then 2001 through 2008, where we had George W. Bush being the president. We had 9/11, of course, and then we had the financial crisis in 2008. And so those are the only 2 terms going back 100 years where a presidential mandate has not produced positive results for the S&P 500. And odds are that in the future, the next president is going to produce positive results in the market. Finally, if you feel you need a retirement or estate plan analysis done, call us, request it. It's well worth making sure you're paying the least amount of tax possible and that you're maximizing your investment returns and you're making sure that all your assets are properly allocated. We also look at the retirement aspect, your insurance needs, if they're adequate. And if you need to have a meeting with me, we can do it virtually. We don't use Zoom, we use another product called Teams. It's owned by Microsoft. I just would provide you with a link and we can have a virtual meeting one-on-one at your convenience. On that note, I just want to say, please stay safe, stay healthy, and I'll see you in the next quarter.